Because we're seeing more and more investment vehicles being created to enable retail investors to participate in private deals, it seemed like a good time to consider what makes private investments so appealing, so attractive, or not. And for reasons that you'll understand by the end of this video, I'm going to view this question through the lens of General Electric. Full disclosure, several years back our fund built a sizable position in GE. During the time that we've owned GE, it's gone from being basically utterly opaque to dauntingly complex to marginally complicated to now vaguely straightforward. By the end of 2018, GE's market cap had tumbled to less than $70 billion from roughly about $500 billion when Jeff Immelt took office. Larry Culp took over in late 2018. He joined the board in April and became CEO in October. By the end of 2021, GE had in 3 years, cut its gross debt by $87 billion, ending 2021 with about $35 billion in debt, $16 billion in cash, and $13 billion in shares of AerCap and Baker Hughes. So since 2018, he's paid down about $100 billion in debt. He simultaneously deleveraged, restructured the business, and transformed the company operationally. When you consider the sheer magnitude of the change that's occurred, it strikes me as very similar to what many companies experience when they're purchased by a private equity firm. In fact, in many ways, GE is a great example of private equity conducted in plain view, but with an important and perhaps ironic difference. CEO Larry Culp has dramatically deleveraged the company. Private equity firms typically boost their returns by borrowing money to finance their purchase, and then they often layer on even more debt so they can issue themselves a dividend, called a dividend recap, so that they can further reduce the amount of their own cash they have at risk. Now look at this 5-year chart of the shares and consider how many opportunities investors had to buy the stock at a massive discount to where they currently trade. Culp had done the financial equivalent of giving birth to a unicorn. And until about 12 months ago, the market couldn't give a damn. The shares traded below $60 for much of 2022. And in March, the board canceled stock awards for Culp, originally valued at $20 million, because he actually failed to hit the minimum performance thresholds. Another more obviously ironic note. Consider how long the share price was depressed despite the objective progress management was making. In effect, Culp was being punished for not delivering the suspiciously steady, predictable earnings that Jack Welch was universally admired for, but were, even really without the benefit of hindsight, a clear sign of the trouble to come. Here's another chart. As you can see, GE has basically kept pace with the S&P 500, but not really, because 80% of GE Healthcare, GEHC, which is now trading at a value of $30 billion, was spun out to GE shareholders. In reality, investors who bought GE prior to the spin-out have seen gains well in excess of the S&P 500. So what's my point? Because private equity firms utilize leverage, their returns on that leveraged equity can be significantly higher than what you'll see in the delevered public equity of General Electric, a lot of publicly traded firms. But GE's returns have nonetheless been superb, and any investor could have captured them with none of the risks, illiquidity, or fees that accompany private investment vehicles. Culp's oversight has been just as sweeping a transformation as you see in private equity much of the time, but conducted in public view and open to the average investor. All you had to do to exploit the opportunity was pay attention, do your research, and exercise some patience. As I pointed out in the 5-year chart, investors had many opportunities to buy GE on the cheap, well after Culp had made material progress on the turnaround. Of course, opportunities like GE don't arise every day, but they're not incredibly rare either. So keep an eye out for them and be careful out there.